And we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. I am welcoming you here to a special bonus video we're doing here at the end of the year. I'm joined by the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. You see these guys on the channel with me every week. Joined as usual by John Lodra and Mike Preston. Gentlemen, how you doing?
Hey, good morning, Adam. Great to be with you. Thanks for having us.
Hi, Adam. Great to be here and look forward to it.
All right, thanks. Well, folks, look, we thought we would squeeze in this bonus video right before the end of the year, in large part because so many questions have been sent by all you viewers over the past couple of days after last week's curveball that the Federal Reserve sent the markets, basically by stating that it's going to be slowing the pace of future rate cuts. They're going to be more uncertain. We're going to talk about this with John and Mike, but that certainly was not what the markets wanted to hear. They sold off hard on the news, recovered a bit on Friday here, start of the week, Monday, the last trading day, or I guess there's a little bit of trading tomorrow, but one of the last trading days before Christmas. Markets opened red, at least. And so a number of you have been asking, hey, is this just a bump in the road, or is this something much more substantial? And some questions around that I'm going to pose to John and Mike here. There are also some other things that have gone on recently too, that may not have everybody's full attention, but could be equally as meaningful. We'll talk about the yield curve that just uninverted. We'll talk about potentially what some of the partisan gamesmanship that just went on in Washington, D.C., some impact that could have going forward. And then we will get to take whatever questions are most burning to those of you watching. We'll take live user Q&A. So why don't we just start this off, John and Mike. Again, thanks for joining me here, kind of impromptu for this, but because we're at the end of the year and people have so many questions, I just thought, let's take the opportunity and strike while the iron's hot here. Let's tackle this first question about the Fed's hawkish cut. I've heard it argued on both sides. I just had Ed Yardeni on the program, who's sort of a well-noted bull. He doesn't really think that it's all that much to worry about. Other people, are saying, look, the market is a discounting mechanism, and when you do a discounted cash flow out when you're valuing a company, you have something called a discount rate that you discount those future cash flow streams based off of. And if that discount rate going out forward is going to be higher than the market expected, mathematically that should reduce what today's present value of those financial instruments are. So I guess to you guys, is this sort of a seminal repricing moment for the markets, or is this just general heartburn that the market will digest and then continue, on its bullish ways from here? John, why don't we start with you?
Yeah, so Adam, the answer is it should matter, right? It should matter if the markets behave like they're supposed to, in theory. You're exactly right. Change in a material forecast of interest rates and a discount rate should affect the present value. Now, we know from hard knocks experience and watching the circus of markets every day that sometimes what should happen and what does happen are two different things. But let's just quickly talk about what happened. So the Fed came out. So first of all, they started their rate cutting campaign in September of this year, just 3 months ago. All right, and it was probably the most anticipated Fed meeting of all time at the time. Every Fed meeting now is the most important Fed meeting of all time. But their first lobby into the rate reduction campaign was in September. They dropped a 0.5 percentage point. This is after 14 months of staying at a rate of 5.25 to 5.5. Okay, so this is a big deal. They telegraphed at the time that they anticipated they were going to be reducing rates by a total of 1 percentage point by the end of 2024. And in fact, now that they've concluded their meetings for the year, that's exactly what's happened. They've dropped their target rate from 5.25 to 5.5 range to 4.25 to 4.5 with this latest quarter point cut. Now, next year is where the difference lies. Back in September, they telegraphed that they thought they were going to be dropping another full percentage point in 2025. That was their prediction. Here we are as of last week's Fed meeting, and they telegraphed only 2 cuts. So a higher terminal rate. But what has happened? First of all, the Fed's consistency has been all over the chart. They have not been consistent at all. In fact, they say they're data dependent, but they've relied so much on their mouthpiece, their so-called forward guidance, that they've boxed themselves into several corners, and they have had to constantly kind of change their tune. And that's what last week was. It was a changing of the tune because they have some concerns about inflation. We can get into all this with some charts and stuff like that. But the market has taken the bait and said, you know what, we think you're going to even be more hawkish than you've communicated. Right now, the CME futures on federal funds rate futures is pricing on just one cut for next year. So in a span of 3 months, the market has went from assuming a terminal 2025 rate of 3% to now it's assuming a most likely scenario of a terminal rate in 2025 of 4%. Full percentage point difference. That has dramatic implications, even for the folks that have been T-bill and chill, quote unquote T-bill and chill. Nothing wrong with 4% for zero risk, right? The other thing I'll just highlight here is that what's happened on the short end is completely different than what's happened in the longer end of the Treasury curve. Ever since the Fed started cutting in September, the long end of the curve has shot up dramatically. I think roughly about 1% higher on the long end, even though they've dropped 1% shorter on the short end. This is so-called bear steepener. Not a good thing if this continues to play out. We can kind of get into all that. But the key question is, what is the real discount rate? Short-term rates are probably not the real discount rate for a stock market. It's probably the longer-term bond market, which is the true appropriate discount rate. And that so far has been very pressured to the upside. So we'll stop there. Mike, you can certainly add plenty of context, I'm sure.
Yeah, jump on in here, Mike.
Yeah, it's just we're all so fascinated with every little minutia move of the Fed. I don't really think that anything major has changed other than the market was surprised with the difference of the 1%, like John just talked about. But in my opinion, they'll probably have to drop the rates much below 4% within the next year. And I think it's going to be in reaction to a big down market. So that's the big thing that nobody's expecting. All the Wall Street strategists are out with their 2025 predictions now. And there's many predictions up in the 7,000 range. And on the S&P 500, and maybe we'll hit that, I don't know, but we certainly, in my mind, won't finish there. So predictions are just predictions. They oftentimes prove to be wrong, and I wouldn't be surprised if the expectation that the market is now setting for Fed rate cuts ends up being wrong as we go through the year.
All right, and Mike, I mentioned in the intro there that we'd had these inverted yield curves for so long, everybody just stopped worrying about them. But we've now had uninversion, at least of some of these yield curves and some of the really big ones. So how material development is that?
It's huge. The inverted yield curve is an aberration. It's not healthy for the economy, and it's ultimately not healthy for the market. Almost always, not always, but almost always, an inversion of the yield curve and then an uninversion leads to a recession and a bad time in the market. We're living through a time where we really think that everything's different now and that nothing matters this time. I think that'll be wrong. This yield curve inversion was as long as I believe the one in the early 70s. There was, and I don't have the chart at my fingertips here, but one of the longest inversions that we've ever seen in history. And usually the longer the inversion, the bigger the market reaction and the worse the news is for the economy. And yet we think that doesn't matter this time either. So the yield curve just uninverted not long ago, within the last couple of weeks, basically. And I wouldn't think that we're going to get an immediate stock market reaction to the downside, but it's a huge warning. And we don't know if we're going to have another run at the top and put in an even higher top and then a drop. Or if maybe we just continue to correct right from here. The market is very uncertain. The market's concerned, it seems. That's why we were down 3+% on the S&P the other day when the Fed announced. But we had a nice recovery on Friday, and here we have a slightly soft market today. So we don't know where we go from here. And so it's anyone's guess. My guess would be maybe a bit of a Santa Claus rally that follows through into next year, maybe. Right into the inauguration. Who knows? But the bottom line is this: we are in dangerous territory. Maybe we go a few more months here to the upside, but I wouldn't be playing, for the very last bit here. I'd be very, very cautious. And I would tell anyone that's watching this or that might watch this in the future, probably time to adjust your allocations. Our allocations are down around the 40% level, a little bit more, maybe 40 to 45%, depending upon the account. But 20% of that is hedged with S&P options right at 5,800 S&P put options. So effectively, a very small drop from here puts us at around 20 to 25%. So just to give you an idea how cautious we are here. So a lot of cross currents, a lot of warning signs, and the uninversion of the yield curve is a big deal.
So Adam, if I could just add, one of the reasons the meeting last week was as impactful as it at least so far has been and will likely be, is just how utterly extreme so many things got. You look at sentiment readings off the charts. I mean, over bullishness, valuations reached literally all-time highs. It's in that kind of backdrop that, and leading into the Fed meeting, there was actually quite a dramatic fall off on market breadth. So the market was already starting to kind of suffer some on its own under the weight of its exuberance. And we got all kinds of anecdotes we can share as to what that exuberance looked like. But it was already kind of very, very much underneath the surface, seeing a lot of falling off on breadth, a lot of stocks starting to fall below moving averages and things like that. And the Fed meeting last week was just enough to kind of accelerate that trend that had already started in earnest.
All right, and the market sold off sharply, as we said. It then recovered about half of its losses on Friday, 2 days later. Now we're going to see where this week goes. But John, I mean, we're still right near those nosebleeds levels, right? I mean, even though the market sold off a bit last week, like I said, half of that's already been regained, and it's like being at the top of Everest and coming down, maybe 100 or 200 feet, right? It's not like we've taken much of the froth out of the system, right? Not
at all. Folks are fooling themselves if they think that was the only thing that was needed to solve the extremities in the markets. This kind of harkens back to somewhat like the tech bubble of 2000. Now, of course, there's differences. Some of the companies weren't as profitable then as some of the big tech stocks today, but in terms of overall valuations, we are more extreme than we on many reliable metrics than we were even then. And I was doing some work for a video that's going to air on our channel later this week. It's kind of generally called the highlights of 2024, key highlights, really with a mind towards what were the key highlights, but more importantly, what are those highlights in terms of what they mean for the year ahead. And one of the things I looked at, and I think we covered this maybe with you last week, but I think this chart deserves some replay here. Basically, if we look at the tech bubble and the kind of the seduction that created for folks, let's look at the Nasdaq 100. This is a chart of the Nasdaq 100, and in October of 1999, the Nasdaq started an ascension that went almost interrupted for 5 months. It went up just almost 87% in the span of about 5 months. And I have an article I can show you here that basically no one was bearish at this. At the end of 99, there wasn't a single bear to be found. In fact, anyone that was bearish was getting ridiculed in the press. But then that started a 2-year decline, bear market in the Nasdaq 100 that saw it drop 83.5%. Now, simple math, one might say, oh, geez, well, you rode up 87, lost 83.5, big deal. You're still up a few percent. That's not how it works. In fact, this shows if you had bought in here and rode the round trip, you still lost about 70% of your money. This is about as, so we may have yet a further melt up here. There's nothing saying we can't, and maybe we likely will. It would be a very fitting resolution to this, most overvalued market of all time. But for investors and the kinds of clients we work for, you got no business trying to play cute here, because it likely will, any kind of further on follow-up melt up will likely be very short-lived and will likely be given back, and then way more than that. So it's really, really, really dangerous territory. A 3% pullback off the all-time high does not solve that by any stretch.
All right. I'm glad you showed that run up in 1999, because this year that we're closing out here, I mean, unless the wheels really come off in the last couple of days, will be, and this sounds, hyperbolic, but it's true, it'll have been the best year in the markets this century and this millennium, right?
Yeah. And in fact, maybe this is a fitting time to look at, how we're going to start seeing all kinds of forecasts for next year. In fact, I've already seen some that not a single one in this particular survey saw a down market next year. Let's look at what history says about analysts, ability to predict markets. So here's a chart that I came across, just public in Bloomberg. This goes back to 2000. Basically, these bars are for each year. So this is 2024. This is the range of forecasts, basically percent returns that analysts had going into the year. And the diamonds are what the year ended up actually at as the time of this writing. So it was almost about 25% return as of this chart. You can see way off the mark. The analysts, basically were way under forecasted, if you will, of the gains this year. And I will point that most of the gains this year have been completely about valuation expansion, not about earnings growth. In fact, over the last 2 years, the S&P's risen like 60%. Earnings growth have risen cumulatively, I think, about 5%. So all about valuation, multiple expansion. But look at the history for, especially at major turning points. Look at the tech bubble. Ultra bullishness, across the board. The market was projecting, at least heavily, very strong gains. Yet 3 years in a row, very sound negative returns. Look at 2008. Not a single analyst in these forecasts predicted negative returns. Look what actually happened, over 40% decline in the S&P. Even 2022, look at this. This is what the range of forecasts were. Here's where the S&P ended up in 2022. So take the forecasts you see on the news channels and throw them out the window, because they have zero value and zero reliability in terms of their predictiveness.
Yeah, and I guess you always got to remind yourself too that Wall Street is in the business of moving product, right? And so they always are going to have a bias to be optimistic and for it to be a good reason to buy whatever financial assets their firm is selling, right? And so, that doesn't mean that they're always wrong. They certainly aren't. But it just means that more often than not, they're going to find ways to tell you it's a good time to buy, just like the real estate market.
Exactly right.
Yeah. All right, Mike, back to the the uninverted yield curve for a second. We've heard many times that, it's not the inversion that the economy or markets have a problem with, it's with the uninversion, right? And so it's almost like a lit fuse, right? Once the curve uninverts, the fuse is now lit, and at some point you're going to see that manifest in a cranky economy or cranky markets. Do we have a sense for kind of what the average fuse time is? I mean, this isn't necessarily something that happens the week after the curve uninverts, but it doesn't take like a year or two to manifest either, right?
Adam, I'm trying to share a chart that Mike and I put together. Do you see it? There it is, yeah.
This one, yeah.
Yeah, you can see this. This goes back to, I guess, the 1970s, but every time it uninverts, well, let me see, is it literally every time? Yeah, basically every time, if you include an almost inversion just prior to COVID in 2020. But look, every time the market this inversion uninverts, and that's when the blue line goes above this horizontal line at zero, you see a gray bar, vertical gray bar, and the gray bar signifies recession. So it's every single time. And this is one of the biggest, longest inversions that we've seen, as I said earlier, with the exception of back in the 70s. And of course, that recession back in 1980 was pretty big. But to answer your question, I don't know that we have the data that tells us how long the fuse is. But I think if you take a look at this chart, you can see it's pretty quick. I mean, if you look at the 1987, 1988, it looks like the yield curve uninverted there. It took a full 2 years for a recession to show up. But as most viewers probably remember, we had a 1987 accident, Black Monday. So, that's why I said that the time is probably short, and we wouldn't be playing games. Like I said earlier, we were 43, 44% with 20% hedged. And if we start to continue to go down from here, we'll continue to take stops and reduce our exposure even more. So I would say months is probably at most what you're looking at. Maybe, who knows, maybe either from immediate to maybe 6 to 12 months. That's what history says.
And just to be clear, things like a recession, there are still indicators out there that are recessionary levels, but the economy is still growing at 3% GDP, right? And so it's highly likely to not go from 3% to a negative print in a single quarter. So we should start to see this arrive as the GDP goes down. But of course, the market should suss out this repricing faster than the economy should. So I'm guessing your 6 to 12 months, Mike, is probably more of a economy fuse and not a market fuse? Do you think the market would actually react beforehand at some point?
Generally speaking, the market predicts and acts ahead of time. Yeah, I think that the market itself, again, it's a guess, but I think the market itself is likely to top out in a few months' time. And the economy would then follow maybe in that 6 to 12 months that I mentioned. But be careful of predictions. They're just estimations. Yeah. This is my best guess.
All right, so folks, pretty soon we're going to be transitioning to pulling your questions here from the live chat. So just a reminder, as you have questions, ask them there, and I'll pull as many in as I can. Let me go back to you, John, for a second. One or two questions for you. Let me start with this one first. So, we had this drama on Capitol Hill last week, right, with a continuing resolution, where a bipartisan agreement was passed, and it was 15,000 plus pages thick, and President-elect Trump, as well as Elon Musk and Vivek Ramaswamy from the new Department of Government Efficiency, or to be created Department of Government Efficiency, put a lot of pressure on Republican lawmakers to say, hey, we got to trim this thing down. It's got a lot of pork in it. And it was a really interesting, experiment in governance, particularly from an administration that's technically not even in office yet. And they succeeded in getting the bill really whittled down, thickness wise. I think the spending was maybe not super different in the thick bill to the thin bill. But they were not able to get past the initial edited resolution. And Speaker Johnson still had to, come up with some sort of bipartisan enough agreement to be able to get the bill to pass. So, right now, depending on who you talk to, it's either a victory or a loss, right? Either the new administration has been able to change the tenor of how these bills are getting passed, and of course they did affect some change in the bill. Others are saying, hey, they really wanted to kind of railroad something through, and they weren't able to do that. Republicans had to make compromises. And where I'm going with all this is, I don't think, my personal opinion, I don't think the threat of a near-term government shutdown, even if it happened, is all that material in the big picture. But part of the animal spirits in the markets since the election has been, all right, Trump's coming in, he's got his disruptive agenda, and he's got all these, key players on his team, and it's going to be totally different from what we're used to. They're going to create all this change and all this disruption that will be positive in the long run, right? And some may look at last week and say, you know what, it's not going to be that easy, right? And again, I say this as somebody who is rooting for a lot of constructive change in how things run in government. But this might have given people some pause to their enthusiasm that, okay, Trump might not be able to get as much done as quickly as we were all thinking because of the huge morass that is DC politics and whatnot. So I'll let you react to this, John, but if indeed the market is beginning to take that kind of message, is that something that could cool the animal spirits?
Yeah, well, by no means am I or anybody here at New Harbor an expert in political budgeting and finance, but I don't think there's not an American alive that would, if they truly thought about this, wouldn't welcome more efficiency, more cost saving in our government. It's pretty common knowledge that there is a lot of waste. Interestingly, though, where is that waste? I saw our friend John Hussman, who you often have on your channel, just put out a tweet or a blue sky note. I think it was on the other platform there. He highlighted how, like, if you look at government payrolls, it's only like 1.5% of GDP, and like defense payrolls I'm talking about is like 0.7%. Meaning, in other words, the actual employment by the government is actually pretty small in terms of total expenditures. But where there is a tremendous amount of waste is in kind of what we would generally call procurement. When the government goes and buys something and gets overcharged. And there was even an article that highlighted how much spending goes out to like external consultants, and they highlighted McKinsey for example, as oftentimes being on both sides of the equation, representing the U.S. government, but also representing companies from whom the government is buying, and the tremendous amount of waste in procurement. But so yeah, absolutely. The market, I think, would certainly cheerlead any cost savings, but I think there's bigger picture things at play. The market has already priced in a whole lot of good things, and at some point you can't double count a lot of good things. And in terms of the likelihood of Elon Musk has put out, for example, a headline comment during the campaign that we think we can cut $2 trillion. Who knows if that's possible? I think it's a very steep challenge, especially when you put in the politics there. I saw a post by Steve Hanke, who you've had on your channel several times, and he commented how he was part of a cost-cutting commission in the early 80s during the Reagan presidency, and he basically poured some cold water on that. It's incredibly difficult to make those cuts, even if they're wide eye open. This thing should be cut. We just saw a little bit of that political theater, and it's probably likely to continue. So bottom line is, who knows, but it's a circus, and we'll be watching it for sure.
Okay. All right. So I'll let you, whichever one of you wants to tackle this one. So one of the trends of 2024 was, I guess there's sort of three things, and try to tie them together here. You had the alternative currencies do really well, right? So great year for gold, really fantastic end of the year for Bitcoin, right? Interestingly, the dollar had a really strong year. What are these different things? What are they telling you guys, and what are you expecting in 2025? Do you expect the trends for each one of those things to continue, three things to continue, or do maybe we hear a very different tune for one or all of those things in 2025?
Adam, we've been talking about the gold breakout for a long time on this channel and in our videos. Gold really has one of the longest bases in any asset that we follow. Going back to 2011, this asset basically spent the next 10 years consolidating, and then the next few years after that, building a breakout or a handle to break out from, and then it did. And then gold went right from 2000 up to 2500, like we had thought the charts were saying would happen, and went up to 2700 or so. And it's pulled back maybe $50 to $100 an ounce, but gold still has a picture perfect technical picture. And it broke out way before crypto did this year, way before Bitcoin. And it did so even with the dollar climbing. So the dollar it sits right around 108 on the DXY basket right now. It's pretty significant on a channel. If it stays here, maybe we can creep higher to 110 or even challenge that old high at 115. But it just broke out of that channel in the last week or two, and so it hasn't proven much of anything yet. Gold still looks to be consolidating its gains, and we still think it goes to 3,000 to 3,500 this year. The dollar, we're relatively unsure, but we're noting the breakout above 108. As far as Bitcoin, we took a small position in Bitcoin in the range of 60 to 65,000 as it broke out of its downtrend that it's been really dealing with for many months. And we took a small 1% position in our model. Happened to be right before the presidential election, and we did not put it on as a bet on the presidential election. Well, then Trump got elected, and basically the Republicans swept the election, and Bitcoin took off, went right to 90,000, our first target. We actually took the position off there because it had reached our target. It did so in basically less than a week or so. Maybe there was a little bit of luck in that timing, who knows? But we essentially acted on the breakout of the downtrend. And since then, we went to a little over 100,000. Now we're back to 95,000. I would say still our faith is greatest in gold. Certainly not in the dollar long term, although we can see it could go a little higher here before rolling over. We think the dollar faces really big headwinds here in the next few years, the next decade for sure. And Bitcoin, honestly, who knows? The chart looks good. It's broken out. Like I said, the blockchain is here to stay. Bitcoin has had many big pullbacks. We've got a chart in our deck that maybe we'll show, but suffice it to say, Bitcoin has had at least two pullbacks of 60% in the last 10 years, one of 40% and two of 20 or 30%. So it's extremely volatile. Our faith still lies in gold. We're still advising our clients to have 5 to 10% gold and silver. Some people have Bitcoin, and like I said, it's more of a trade for us than a store of value.
And just on Bitcoin specifically, there's a big debate that's been raging, especially since Bitcoin had that big run into the end of the year. That obviously you get the Bitcoin faithful who have said, hey, this is a reflection of the decline of the purchasing power of the dollar, and people are getting on board that train. And then you have the other side saying, no, it's just a massively speculative asset, and it's sort of one of the most risk-on assets out there. And as long as markets are in risk-on mode, it's going to do great. But if markets then tip into risk-off mode, it's going to sell off pretty hard. I will note that while we were talking here, you said 95,000. Mike, it actually cracked below 93,000. It's now back a little bit above right now. But it has come off fairly substantially since the Fed surprised markets, right? And so it is acting like as risk on has muted a little bit, moderated a bit, so has the Bitcoin price, and obviously to a greater extent than the general markets. So I don't know what the answer is, and I'm guessing you guys would say you probably don't either, and we'll all wait and see and learn together. But if you have anything to say about that, feel free.
And we don't really know what the answer is, and I'm not afraid to say that we admire the blockchain. We think that Bitcoin has proven itself from a chart perspective. We're still very reluctant to delve into Bitcoin in a big way. We feel confident saying that one should have 10% of their assets in physical precious metals. We don't feel confident saying one should have 10% of their assets in Bitcoin. So again, it's proven itself. It's a limited supply. I know 21 million coins. It's kind of cool how the whole thing was set up, but it's still unproven. It still has large pullbacks, and I don't know that the kind of the fervor or the excitement that community has is really warranted. One thing I notice is that the community is kind of all in a lot of times, saying Bitcoin is the new gold and gold is an old shiny relic. I personally think that I would want to be over allocated in gold and silver and maybe dabble a little bit in crypto. And I just can't see one doing well without the other. So I don't see how that would be bad advice.
Okay. All right. Well, look, I'm going to start jumping into the user questions here. There was one I'm trying to find here. I'll ask it and then I'll pull it up. But they were commenting on how much TLT has been getting beaten up. And on the day we're talking, long bond yields are rising again. And just for the folks that don't know what TLT is, it is an ETF that basically tracks the prices of long-dated U.S. treasuries. I think its average duration is about 20 years. So, John, Mike, either one of you can take it, but yeah. Which one do you want?
I can take that. Yeah. So there's been a contradiction. Short-term rates have dropped a full percentage point. Long-term bonds, if you look at 10-year treasuries, they've risen about 1% in the time the Fed has started cutting rates. So there's been a massive, and Mike talked about it, the shifting, the uninversion of the yield curve. I'm going to share a screen here to put this in a picture here.
Great. And John, as you do, and as you answer this, try to address Steve's question here about astounding cheapness. So, as you give your feedback, is TLT, in your opinion, astoundingly cheap, or do you have a different opinion?
Yeah, I'll definitely talk about that. So here's just a picture. These are two yield curves going from 0 to 30 years in duration. The red one is the day before the Fed started cutting rates on September 18th. The blue one is as of this past Friday. So you can see the short end of the curve has predictably dropped with the Fed's cutting of rates by a full percentage point. And you can see the long end has spiked higher. The 10-year, for example, went from about 3.6% in yield to about 4.5% on Friday. And people know when yields rise, bonds sell off. Why are bonds selling off despite the Fed cutting rates? I think there are three main things. One is worries about the deficit. This is a chart of the federal deficit as a percent of GDP. Massive increases of deficits. Foreign investors, foreign countries are starting to get really worried about that. They've been very vocal about it. Not only vocal with their words, but also their actions. The World Gold Council, for example, does a survey of central banks every year, And in that survey, central banks across the world said very clearly, we expect an increasing percentage of our reserves over the next 5 years will be in gold and not US treasuries and dollars. Not only have they said that, but they've done that with their actions. We've seen that. Inflation. This is a chart of CPI and real yields. What we've seen is a massive coming off of the rate of inflation, not the inflation level, but we've seen it start to plateau here and actually hook up. This is just CPI. There's a whole nother conversation we could have about inflation and where that may be going. But right here is where the Fed started cutting rates. These are the real break-even yields by the Treasury market. Basically, it's the market's expectation of inflation. Those have shot up since the Fed started cutting rates. The other thing is there's this notion called a term premium. It's kind of an academic term, but basically it's the premium that longer-term investors demand for taking on longer-term treasuries compared to just rolling short-term treasury bills. And the term premium has been artificially low for many, many months, in fact, years. Largely, we think because of what the Fed has done to distort the bond market. That has started to rise. In fact, the term premium has spiked since the Fed has started cutting rates. And if you got back to normal, the term premium, I think right now in the 10-year Treasury is about 0.5%. There's still about another 1.5% that the term premium could rise just to get back to long-term averages. So the simple answer is the yield on 10-year and 20-year Treasuries has gotten much less overvalued or undervalued, however you want to look at it. The bottom line is no, we don't think TLT is a pound the table steal right now. There is every bit a scenario where we could see 10-year yields go up to 5.5%, 6% and not be extreme from a historical standpoint. It's not a projection that that's going to happen. We think about things in terms of probabilities. But when I hear someone ask, is TLT a steal? I think of a 99% probability. No way in heck do we assign a 99% probability, at least based on current data, that we have bottomed in the bond market. Maybe it's a 60% chance and a 40% chance that we're still going higher on yields, but that's where we're very cautious. We have a 7.5% allocation to long-term bonds. The rest of our bond allocation, which is very significant, is all short-term treasuries. And we are perfectly happy staying with that kind of tilt until we see some more resounding reasons why the long-term treasury should rally. And one of the reasons that we might see for that is if we start to see some more meaningful signs of recession. The recession indicators are kind of a mixed bag right now. There's not a very clear signal of an incoming recession. There are things like household survey of employment starting to show some weakness in the job market, but the jury's still out there. So not pound the table steal, having a modest allocation, certainly appropriate within a broad financial plan.
All right. And John, I don't know if you get the data handy, but what are credit spreads telling us right now? For a long time here, the bond market has been saying, we're not worried, right? Because that's what credit spreads are an indicator of.
We don't have a chart handy, but we watch those. We don't have a chart handy. We watch those very closely, and they haven't really spiked much at all. The credit markets have been very complacent. They're at near record narrow spreads. Bottom line is the credit markets haven't been rewarding people for taking more risk in things like junk bonds. We'll be watching it closely, but there hasn't been a meaningful spike in those spreads as of yet.
So let me dig into that just for a second. So look, the stock market has been has run off to record levels of euphoria, right? As we've talked about recently in past weeks in this channel, right? Like literally, the euphoria meter is at the highest level it's been at in the data series that we looked at, which went back many decades. So you could say, okay, then tight credit spreads are kind of the bond market's equivalent of that, right? The stock people aren't worried, bond people aren't worried. But if we're seeing yields creep up on the longer end, especially in contrast to what the Fed's doing on the short end, that seems to signal that bond investors are worried. So how come that's not reflected at all in credit spreads yet? Is there a credible explanation for that? Or, and I'm raising a question, I don't know the answer to it, or do credit spreads not send the quality signal they used to send in the past? Like some people say the VIX is somewhat of a broken indicator. Could credit spreads be compromised somehow in this new order?
There's two things here. There's interest rate concerns and there's credit worthiness concerns. So far, the only concern that has been expressed in the bond market is that of interest rates. Okay, so the spreads have remained very narrow. So it doesn't mean the yields haven't gone up; they just haven't gone up dramatically more than Treasury yields. So the spreads have stayed very narrow. Now, when the market starts getting worried about credit worthiness, and that typically happens when recessions are incoming, because people are worried about companies' ability to repay that debt, especially if earnings are down and they've overextended themselves on debt, especially given we all know about this upcoming maturity wall that is the mythical thing that's out there in the future, but not yet a concern. That will become a reality. And if we don't see yields come down in a meaningful way, and certainly if they go higher, I almost guarantee that we're going to start to see some strains in the credit spreads and a blowing out of those relative to Treasury markets.
And wouldn't you, forgive me if this is a naive question, but like, given how far the long-term rates have moved relatively recently, just mathematically, wouldn't you say, okay, so you know, as companies that aren't top tier companies have to continue to refinance at these rates, they're going to be paying more, and some of them are going to have a harder time paying. Like shouldn't higher bond yields just mathematically lead to at least some additional concern about credit risk?
They should in our book, but they don't matter yet to a market that's full intent on closing its eyes.
Okay, and all right. So to your point, if that's how you see it, a market that's fully intent on not opening its eyes or whatever, does that mean that you guys had to have this fear inside you? And fear might be too emotional word, but a concern that that there is going to be kind of there's a concerningly high danger of the market waking up one day and just saying, "Oh my God, we had our rosy colored glasses on, and now that we're seeing the world differently, we have to reprice in a hurry," right?
Yeah, so yeah, it absolutely does give us concern, but we need not predict that. It's enough to say that you're not being fairly adequately compensated for that risk right here and now. So there's no need to be in that market. Not because we necessarily think it's going to implode, probably will at some point, but you're not getting adequately compensated. You might as well just be in treasuries if you are intent on having a longer term bond allocation that you plan to hold to maturity, than not getting compensated for the credit risk of a pretty overvalued high yield junk bond market, in our opinion.
Got it. Okay, so this is sort of the bond equivalent of the equity chart you showed leading into the 2000 bubble, which is, hey, there's maybe some more upside ahead of here, but it's probably not worth the risk that you're taking, given where things are. Okay, you're nodding. All right, Mike, here's a question that's been asked. And you guys at New Harbor might do something differently, so feel free to answer the question in the way that New Harbor would do it. He said, if one wanted to use a hedged negatively correlated ETF or inverse ETF to hedge a 50% equity allocation, which ETF would you, New Harbor, use? QID, SDS, something else?
Okay, well, this is a big question with a lot of different answers, but the question asks about which ETF. So I'll try to stick to the ETFs, because there's other ways to hedge besides buying ETFs. For instance, you could sell down the position. Now, I'm assuming that this person that asked this question doesn't want to sell the position. You could also use options, which is what we often do. But you could also use inverse ETFs, which is what they asked. First thing I would do is avoid the leverage inverse ETFs. There's 2x, which are pretty common, and even 3x leverage ETFs. These ETFs use swaps and options and futures and things like that to try to match the performance of an asset on a single day. It is difficult to stay with the leverage ETFs for a long period of time without experiencing some type of tracking error. That tracking error can be positive or negative, but it's often negative if you have huge volatility swings, particularly in assets that have huge volatility swings. So ETFs that are leveraged or leveraged inverse in specific stocks or specific sectors can have really bad tracking error over time. So I would stay away from the leveraged funds and stay with the unleveraged funds. Hopefully you've got enough cash to do that in your account. If you don't, then options are a good way to do it. And you can reach out to us and talk about that if you'd like. But answering this question with options is really kind of beyond the scope of what was asked. So first, I'd look at your portfolio and see basically what type of stocks or investments that you have. The biggest, most liquid inverse ETFs are going to be the big indices, the S&P, the Dow, the Nasdaq. For lack of knowing what this person's portfolio looks like, let's just assume that the S&P 500 is most representative. It's most representative for most people. So I would look at an ETF like SH, Sierra Hotel, versus SDS, which I think was in the question. SDS is the double inverse fund on the S&P 500. Again, I'd stay away from that. I would use something like SH. So if you had a $100,000 portfolio and 50,000 of it was in stocks and you wanted to completely hedge, you'd have to buy 50,000 worth of SH. But you don't necessarily have to completely hedge. You might want to hedge $20,000 or $30,000 of it, in which case you'd buy $20,000 or $30,000 worth of SH. If you don't have the cash to do it, that's why these leverage inverses exist. But I would strongly advise that you try to learn options or reach out to us, and we'd be happy to chat with you briefly and give you an example of how you can hedge using options if you don't have the cash to do it.
All right. Two things on that last point there, Mike. Folks, if you're interested in learning about the basics of hedging with options, John and Mike recorded a good primer for this audience a few months back. If you go to thoughtfulmoney.com/hedging, you can watch that video. And gentlemen, we talked over the past week or two about how relatively inexpensive put options on the S&P had become. You said it was one of the cheapest moments in your guys' entire career on a relative basis. And anyone that decided to take advantage of those options when we initially talked about them prior to the correction post Federal Reserve meeting, is probably pretty happy that they put them on. What's the level of affordability of puts now, several days after that corrective event? Is it still pretty affordable, or have prices changed a lot?
It's still pretty affordable, Adam. I'm taking a quick peek at VIX right now. I mean, VIX it's settled in at around, it looks like 18 right now. Just to give you an idea, about a week or two ago when we talked about how cheap options were, VIX was around 12 or 13. And that's not the all-time low, but it's getting close to the all-time low. The all-time low in the last few years is about 9 or 10. So at 13, options were being priced pretty cheaply. And the VIX, the volatility index, is a major component in that pricing. Last week, the VIX popped to, I'm just taking a quick look at the chart here. We went right up into, I think, the 30s, almost 30. It looks like, it looks like we almost touched 30, and here we are back at 18. So relatively affordable. The jury's out as to whether this trend will continue. But personally, I think that this drop in the stock market might have been a little bit of a head fake / scare. So I wouldn't be surprised if we have a little bit of a Santa Claus rally here. And again, as I said earlier, maybe a move into the election. If that happens, the VIX will continue to drop back into the low teens or lower. So with 18 on the VIX, I wouldn't say that they're cheap. I wouldn't say that they're expensive. They're more towards the middle of the road of what we've seen in the last year, maybe even slightly higher than the average of the last year at the moment.
All right. Thanks, Mike. All right. We're beginning to get near the end of our time, folks, but I try to squeeze in one or two more questions. Do John and Mike use Jake Bernstein's Daily Sentiment Index to help time market turns? If not, could they please remind us of what they do use for that?
Thanks for the question. We don't particularly follow or use that particular sentiment index. For us, sentiment is more of an anecdote to other things. So anybody that's seen us on your channel, Adam, know that we certainly pay attention to valuations, but not in the context of a short-term timing tool, but more in setting the backdrop for the risk environment. And when the shoe drops, how far it likely could drop. But for shorter term moves, we use a whole host of technical indicators. Many of them are moving average participation type indicators, percents of stocks above or below certain moving averages. We use things like bullish percent indicators, which whether you're looking at across a broad market or sectors. It basically measures the percentage of stocks within that universe that are on buy signals. So we have a whole battery of short, intermediate, and long-term indicators that use technicals and really momentum and relative strength to help us listen to what the market is telling us. One of the things that we as advisors and investment strategists have had to learn many, many times in our careers that the market is going to do things that you can't explain, that there's not logical connecting the dots. And sometimes the more articulate a theory you have about something, the more ripe you are to get proven wrong. Okay. So much of our system is meant to just listen to the market and to listen to what it's telling us. It's why we're in certain sectors like financials and out of other sectors like energy. Energy categorically could be viewed as undervalued relative to the market, but it's been one of the poorest performing sectors from a momentum and relative strength standpoint. So we've been largely out of that sector. Sentiment for us is more of like kind of an anecdotal, hey, how extreme is this getting? We know the valuations are extreme. We know the things are overbought. They're extended on short-term moving averages, things like that. But when you load in the kind of sentiment where you see headlines in the major newspapers talking about embracing the bubble, like don't try to fight it, these are the kinds of things that check that extra box that, hey, this is bound to move sharply when it moves, and just time to batten down the hatches. So hopefully that answers that question. That particular index we don't follow, but appreciate the question.
All right. Okay. Well, look, in our final minutes here, you guys talk to people every day. You've got hundreds of clients there at New Harbor, maybe thousands. And certainly you get a lot of viewers of this channel who are reaching out and having those consultations, those free consultations with you guys. So you guys have your fingers on the pulse of, what average just regular people are thinking, wrestling with these days. Maybe let me try to cram two questions into one here. One is, what are you guys observing, hearing the most right now from folks? What are the questions, concerns, or hopes that people are looking for help with right now? And then secondly, for the folks that didn't take action over the past couple of weeks, as we've been advising everybody to get their end of year planning done before the January 1st deadline, is it too late, or is there still time for them to work with financial advisors, you guys, or if they already have an existing one, to do things like portfolio rebalancing, tax loss harvesting, and all the other things that we talked about?
It's becoming too late, Adam, to be honest. One of the big topics that we've been talking about the last few weeks with people has been Roth conversions. And to be clear, we're not really big fans of Roth conversions. Personally, I don't like the idea of spending money on taxes now versus later, particularly when we think that dollars today might be more valuable than dollars down the road. But there are exceptions. For instance, if you're in the 12% tax bracket, which is up to about $90,000 or so for a married couple, $45,000 or so approximately for single filer. If you're below then, or below that level, it might make some sense to convert enough to bring you up to the top of that bracket, because if you can convert at 12%, it makes some sense usually. Once it's beyond that, it becomes more dicey. But it's actually a little bit late here, because our custodian Schwab is basically saying at this point it's best efforts basis to get new accounts opened if you don't already have a Roth, and to do a conversion. So I think it's a little late for that, for people to start thinking about it. So I'd probably put that on for next year at this point. But there's still time to do gain loss harvesting if they have good gains, and the market has had strong performance this year. So I don't think it would be a surprise that people would have realized gains. If there's any losses to take, you can do that. You can swap one symbol into the other. Sadly, we have some losses, not a lot, but we have some losses. For example, in TLT, we just swapped out that symbol for another similar symbol to book that loss. You can swap symbols. You can sell one and buy something else that's similar, as long as it's not the exact same thing. That's allowed, and you can book that loss.
Hey, so, just on that, and the reason why I think you're doing that is because there's a wash sale rule that says if you want to sell something to lock in losses, you can't buy it back until 30 days later. And so,
Correct.
but you're saying, hey, I want my portfolio to still be positioned in a similar asset to that one. So you can, as you said, you can buy a symbol that's very similar and pretty much does the same thing. But as long as it's not the exact same thing, you're not triggering the wash rule. Just want to make sure I have it correct.
Yeah, that's right. Obviously, this shouldn't be construed as tax advice, but our viewpoint is that you can sell one asset and buy another asset that's similar, but a different symbol, a different ETF provider, and it's allowed. So you can still have exposure to, for instance, long-term bonds, but you can book that loss this year. So there's not a lot of losses on the books. That's just one example from our own experience, and maybe folks that are watching this have other losses they can take. You really have up until the last day of the year to do it. So think about taking those losses. It makes a lot of sense.
Okay. So what I kind of hear from you, Mike, is time's running out on some of these tactics, but still time for, a lot of other ones that make sense. I also would think, and correct me if I'm wrong, there's still value, even if they don't take those steps you just mentioned there, Mike, meeting with a financial advisor and getting a plan for 2025. The sooner you do that, the better position you can be for the start of the year. So there's even still time for that. Or even if you miss the January 1st deadline, talking to somebody and getting your plan in the first week or two of January, probably vastly better than just trying to figure it out on the fly as the year goes along, correct?
Yeah, I wouldn't even worry about getting it done by the 31st at this point. If you can, that's great. But if not, just get an appointment booked in January. Because the planning issues that we're talking about really are applicable for the whole year. And for instance, opening up retirement accounts and funding retirement accounts can generally be done up until April 15th. So they don't have to be done by calendar year end. Reviewing insurance coverage or even personal like property and casualty insurance, something that people should think about every year. And it's a good time in the beginning of the year to review that and maybe talk to your agent. And we as financial advisors, financial planners often point those things out to people. All those things are not really bound to some kind of calendar at the end of the year. So just do it in January. Talk to your advisor if you don't have one. Or if you'd like our opinion, reach out to us. We'd be happy to chat.
Great. And obviously, if you want to reach out to these guys or any of the financial advisors that Thoughtful Money endorses, you can do that at thoughtfulmoney.com. And there's the URL right there. Click on it. Takes you only a couple seconds to fill out the form. The firms will then be in touch with you right away. There's no cost to these portfolio review consultations. There's no commitments. It's just a free public service these guys offer to help as many people as possible position as prudently as possible for what may lie ahead. Hey, John, I'm going to let you, begin to land the plane here. So this is New Harbor's last appearance on the channel before the Christmas holiday. I know that you guys aren't just money advisors to people. You are sort of life advisors. Again, your goal, your objective is to help them fund their life goals. Obviously, having great quality time with your family is a big part of many people's life goals. Do you have any sort of parting bits of advice to folks as we head into the holidays?
Yeah, a big part of what the broader mission that we hope to serve is to help reduce fear and anxiety when it comes to money. We find that we humans, our clients included, oftentimes carry fear and anxiety, oftentimes unjustified fear and anxiety. And big part of what we try to do is illuminate for them, what their needs likely are to be, what their resources are, and get them focused on making sure they preserve and protect what they have, especially if it's plenty sufficient for their needs, and not to try to chase, bubble markets, last stages higher of a bubble market, which we're not bashful about calling this. And honestly, sometimes we have to, more often than not, we have to encourage our clients to use their money in ways that are enjoyable or meaningful to them, because we are trained to be worried about things. So that's one of the things we just encourage folks to take a step back, forget about the circus of the news headlines of financial media. Don't think about things in terms of calendar years. Your lifetime is a tapestry of many, many days and moments, hopefully not calendar years, because certainly the financial markets don't care about financial years. Take a step back, think about your life, your needs, your desires. Our observation is that folks that find contentment in the simpler things, people, community, connection, is the best awakening they can have from a financial standpoint, far beyond what we can do for them.
All right. Well, very well said, John. I'll close by just remarking on an article that I just read. And it was basically sort of lessons learned by a hospice nurse, woman who's been in hospice for decades. And as viewers may recall, both my parents died last year. My mother died in hospice. I know both you guys had parents pass away. And first off, I got to give a shout out to hospice workers. They're just a different breed of person, and thank God they're out there. They're literally walking saints. But anyways, this woman has seen a lot of people die, over her multi-decade career. And she said the thing that they regretted most, that she heard people regret most in their last days, was not appreciating what they had. And it wasn't appreciating things, it was appreciating benefits. Like just, hey, I had good health and I felt good and I just kind of took it for granted. Or my family was around, or the people in my life. I didn't hold on to that and appreciate it and savor it as much in the moment as I now wish I did, because as I'm reflecting back on my life in my last hours, those were the things that truly mattered, right? It wasn't the money, it wasn't the trappings. As we talk about on this channel, it was the people, the purpose, and just the great privilege of being in good health for much of your life. So highly recommend that everybody take stock, take a beat. Don't look at your portfolios, don't look at the markets, don't look at the news, and just look around you and really just savor the things that you have that, if you didn't have, you realized your quality of life would be dramatically diminished, and just feel very happy and privileged for what you got. And even better, reflect that back to the people who are important to you in your life. And one last thing around that, we've talked about this a fair amount in the past, but most people watching this channel, I think, are kind of the primary financial quarterback for their families. And a lot of them don't have a succession plan. We've talked about this issue where oftentimes, sadly, the financial quarterback will get impaired, they'll die, they'll get sick, whatever. And then the family basically is all of a sudden struck with having to figure out, oh my gosh, like, who's going to take over from them? In a lot of cases, these people don't have the training, the experience, the know-how. They don't even know necessarily where the accounts are or where the passwords to access them are. And so the holidays are a great opportunity to sit and talk with your family and just come up with a plan, right? Hey, how do we want to handle this? If I'm the financial quarterback and all of a sudden I'm taken out of the game, how do we want to handle this? Does one of you want to take over the torch from me? Or would you rather have us find a professional who can do it for us? And then make that a priority in 2025 to just set that up. And hopefully you'll be the quarterback for many years or decades going forward. But just in case not, your family is not going to be caught unawares and have a massive life curveball to have to stressfully deal with. You'll actually have a plan that you'll put in place for a very seamless transition. So if you can, take some time this holiday with your family to try to have that conversation. All right, John and Mike, very much appreciate you guys. You guys are something that I'm very, very grateful for in my life. I need to hear the same from all your clients and for the people who watch this channel who reach out to talk to you. So thank you all for that. I wish you guys the best of holidays. I'll let you give your holiday wishes to the audience here, and then we'll wrap up.
Same to you, Adam. We wish you a happy holiday and a happy new year. And of course, to all of your viewers and those that are listening right now, thank you for joining. We appreciate the opportunity to be a voice. Without you, we wouldn't have a voice. So thank you very much.
And I'll just add my thanks and appreciation, Adam, and wish many blessings to you, your viewers, and may we have a peaceful and prosperous year ahead for all of us.
All right. Well, look, I'll just echo everything you guys said. Let folks know here that we've got big plans for Thoughtful Money in 2025. I've got a really fun, positive announcement that you guys will be hearing very soon in the first week of 2025. But I'll leave that as a teaser for now. That's a present you'll unwrap after the New Year's. But like John and Mike said, I just wish you guys all the best. Wonderful time with family and friends, good health, and look forward to seeing you guys on the channel going forward from here in the new year. All right, John and Mike, thanks so much. Everybody else, thanks so much for watching.